Welcome back to 9 ways to lose money in the market. Number 6, misjudging luck from skill. We can have a run of winners, but how do we know if that was skill or just good luck? It can be really tempting to think that we've cracked it and to not even contemplate that it might have just been a run of good luck. This can make you scale up, use extra leverage, have overconfidence, and when you find out actually you just had a run of good luck, you can end up shooting yourself in the foot or the neck.
They say it can puncture the skin of a rhino from 100.
Ow! And that's the tricky thing about trading. It's very hard to know if it was luck or if it was skill. Likewise, you could have a really good system but go through a period of bad luck and ditch your system, thinking that it doesn't work. Ultimately, you need a lot of data to see if you've got a robust system. But a successful back-tested strategy doesn't necessarily mean it'll be successful moving forward. The stock market's fluid and it changes all the time. Setups that did work may not work for a number of reasons. Let's have a look at one reason. And this is a simplified explanation, but it's sort of what happens in the stock market. Let's suppose you're following a guru and he or she suggests penny stocks, and every time they suggest penny stock it goes up. Let's say it goes up 200% and then it falls back down to earth. Now this can happen over and over, but what will happen is people will just start selling a bit sooner because they don't want to get dumped on. See, if you're buying up near the top and it dumps, you're going to learn your lesson. Well, I hope you learn a lesson. So people will start to know this and it will sell sooner and sooner until eventually your guru will mention a stock and people will know it will probably just dump straight away. Now this is going to attract dip buyers. So then you've got a whole different dynamic going on where the stock, people sell the stock very quickly, dip buyers come in and buy it up. Maybe that's a new strategy, and the market is fluid all the time. People are creating and destroying different edges within the market. Number 5, overconfidence bias. Overconfidence bias is a tendency to hold a false and misleading assessment of our skills, intellect or talent. In short, it's an egotistical belief that we're better than we actually are. It can be a dangerous bias and is very prolific in behavioural finance. We touched on this before. It can be easy to assume our good luck is actually good skill. That's because we are generally overconfident. Overconfidence relates to risk size and over-leveraging. You may have multiple times when you have aha moments where you feel confident that you've figured it out, but your brand new trading plan is very often simply just random good luck. Number 4, loss aversion. Research has shown that our brains typically assign 2.5 times the weight of a loss as it does to a gain. We fear a loss so much that we can make illogical decisions. Have a look at these options here. If you were offered a guaranteed $500, would you gamble it on a 50-50 chance that you could either be given $1,000 or nothing? Most people would just take the $500, not wanting to lose, and walk away with nothing. However, if we flip it on its head and said, you've got to pay $500, you've now lost $500, would you gamble with a 50-50 chance that you could lose double that, $1,000, or that you could walk away with no loss at all, no gain, no loss? In this scenario, most people will flip the coin, desperate to try and save themselves from losing the initial $500. Recognising loss aversion can help protect you in the markets. Some of the results are that traders tend to sell good stocks too quickly, wanting to capture those gains. But they also tend to hold on to losing stocks, not wanting to realise the losses. And sadly, many investors are not risk averse, they're loss averse. So it makes investors behave irrationally and do whatever they can to not realise a loss. Taking a loss is part of trading, especially day trading, where you're in and out very quickly, and holding on to a bad trade, especially if you've got leverage, can literally blow up your account in a single day. Becoming comfortable with a loss is part of the challenge.